In 2025, more Americans are involved in the stock market than ever before. Surveys show around 62% of U.S. adults now own stocks either directly or through retirement accounts. If you glance at the S&P 500, it has nearly doubled in the past 5 years. At first, this might make it look like everyone is getting wealthier, but the reality is very different. The truth is, most retail investors lose money in the stock market. Wall Street even has a term for them: capital donors. Studies show that roughly 3 out of 4 regular investors underperform the market. Their losses often fuel the gains of professional traders and wealthy investors. At the same time, the wealthiest 10% of Americans control nearly 90% of the stock market's value. That means the vast majority of growth and profits flow to a small slice of the population. Why? Because the wealthy use very different strategies. In this guide, we'll explore exactly how the rich invest, starting from the basics of everyday investing, then moving through the strategies used by millionaires, and finally the advanced systems billionaires rely on to build and protect generational wealth. How everyday investors build wealth. The first step in understanding the gap is looking at how the average person invests. Most people begin with blue chip stocks. These are large, established companies such as Apple, Microsoft, or Coca-Cola. They're global leaders with stable earnings and long records of surviving economic downturns. The strategy here is straightforward: buy shares, hold on to them, and let the power of compounding work over time. This works. For example, investors who simply held Apple stock for the past 5 years doubled their money without doing anything fancy. The key here is patience. Instead of trading constantly, you let your money grow alongside companies that continue to innovate and pay dividends. But there's a risk. If you invest too heavily in just one company and something goes wrong, a scandal, a technology shift, or new competition, your portfolio suffers. That's why many small investors move toward index funds and ETFs. Index funds allow you to own tiny pieces of hundreds or even thousands of companies at once. They spread your risk across industries and regions. Many people access them through retirement accounts like 401ks or IRAs, which also provide tax benefits. And the best part? This strategy doesn't require daily monitoring. History shows that simply buying an index fund, holding it, and reinvesting dividends has been one of the most reliable ways for regular people to grow wealth. The next step is diversification. Instead of holding only U.S. tech stocks, smart investors spread across sectors like healthcare, energy, and finance. They might even add international companies, bonds, or real estate trusts. Diversification doesn't guarantee high returns, but it reduces risk. If one market struggles, another may hold steady. Over time, this creates smoother growth with fewer painful drops. For most Americans, this is the entire playbook: blue chip stocks, index funds, ETFs, and diversification. It works, but it's only the entry-level approach. The real difference appears when we look at what millionaires do. How millionaires invest in 2025. Millionaires also invest in stocks, but they do it differently. They are not gambling on hype or chasing tips from social media. Instead, they use research, strategy, and discipline. Some millionaires practice value investing, looking for strong companies that are temporarily undervalued. Others search for growth opportunities. Firms innovating in areas like artificial intelligence, green energy, or biotechnology. Either way, they don't just buy what's popular. They dig into financial statements, trends, and fundamentals. But even skilled stock pickers know they can't always predict the future. That's why millionaires spend as much time protecting their money as they do trying to grow it. One powerful tool here is hedging with options. A classic example is Mark Cuban in the late 1990s. After selling his company, he held $1 billion in Yahoo stock. Knowing the dot-com bubble might burst, he used a strategy called an options collar. This gave him the right to sell at a fixed price if the stock crashed, while limiting how much more he could gain if it soared. When the bubble collapsed, Cuban kept his fortune intact. This shows the difference. Millionaires don't just hope for the best. They prepare for the worst. Some also use margin and leverage. By borrowing money to invest, they can amplify gains. For example, with $1,000 of their own money and $1,000 borrowed, a 10% gain turns into nearly 20%. But if the investment falls, the loss is doubled too. Leverage is risky, but when used carefully, it accelerates wealth building. Millionaires also invest through hedge funds. These are private funds managed by professionals who use advanced strategies unavailable to average investors. Some hedge funds specialize in global bets, others in special events like mergers or bankruptcies. Bridgewater Associates, for example, studies global economic trends to place large bets on currencies, interest rates, and commodities. Renaissance Technologies, a famous quant fund, relies on algorithms and massive datasets to make thousands of trades each day. Its Medallion Fund has produced returns far above the market for decades. The bottom line is that millionaires don't rely on luck. They use tools, hedging, leverage, hedge funds, and professional research to tilt the odds in their favor. How billionaires invest in 2025? Even hedge funds have limits. They can grow wealth, but they don't manage long-term family needs, like taxes, inheritance, or philanthropy. That's why billionaires set up family offices. A family office is like a private wealth empire. It employs teams of financial experts, lawyers, analysts, and tax planners who work only for that family. This structure allows billionaires to take investing to another level. Here are some of their main strategies. 1. Private equity and venture capital. Billionaires often invest in companies long before they go public. This is how early investors in Google, Facebook, or Stripe turned millions into billions. These opportunities aren't available to most people because they require enormous capital and connections. But for billionaires, they're standard practice. 2. Tax loss harvesting. When one investment loses value, billionaires don't simply hold and hope. They sell it, lock in the loss, and use it to cancel out taxable gains from other investments. This lowers their tax bill while keeping their money working. 3. The buy, borrow, die strategy. This controversial but legal method allows billionaires to avoid paying taxes on their gains. Instead of selling shares, they borrow against them. Borrowed money isn't taxed as income, so they can access billions without triggering capital gains taxes. When they pass away, their heirs inherit the stocks at a new stepped-up value, wiping out the tax bill. 4. Donating appreciated stock. Billionaires also donate shares instead of selling them. By doing this, they avoid capital gains taxes and receive a charitable deduction. This is why Warren Buffett, Bill Gates, and Mark Zuckerberg have donated tens of billions worth of stock. The lessons for 2025. Looking across these levels, the pattern is clear. Everyday investors win by keeping it simple. Blue chips, index funds, ETFs, and diversification. Millionaires add more advanced tactics. Stock research, hedging, leverage, and hedge funds. Billionaires go further with family offices, private equity, tax strategies, and wealth planning for future generations. But the biggest lesson is this: investing doesn't usually create wealth. It preserves and multiplies it. Most billionaires became wealthy through businesses, innovation, or breakthrough opportunities. They then used investing as a system to protect and expand what they already built. For everyday people, the key is discipline. Avoid gambling, avoid chasing hype, and focus on consistent, long-term growth. Build a foundation with diversified investments, use retirement accounts for tax advantages, and let compounding do its job. For those with more wealth, advanced tools become available, but with higher risks and more complexity. At that level, expert guidance becomes essential. In 2025, the markets are more competitive and global than ever. Technology, artificial intelligence, and data-driven strategies dominate institutional investing. Yet the basic truth hasn't changed. The investors who succeed are the ones who stay disciplined, manage risk, and think long-term.